We just finished going through ARM Holdings FY2027 Q1 earnings call materials, and now we want to share our takeaways with everyone. Start with the number the company put right on the front page. Revenue hit $1.29 billion, up 22% year over year. Both the licensing stream and the royalty stream broke their Q1 records. Now hold on, don't celebrate yet. The same company that printed those records also walked its full year royalty growth expectation down from about 20% to high teens. Records in one hand, a downgrade in the other. Sit with me for a bit, and I'll walk you through why both of those things are true at once. The company frames this whole quarter around three things at once, and I want you to hold all three in your head. First, record highs. The company's stated revenue hit $1.29 billion, up 22% year over year. Both the licensing stream and the royalty stream broke their Q1 records. Second, the downgrade. The company itself lowered full-year royalty growth from around 20% to high teens. Third, the bottleneck. The company reports immediate demand for its new AGI CPU tops $2 billion, but supply is hard locked at $1 billion. Most management teams would bury the second and third items somewhere deep in the appendix. ARM put all three right on the cover. The subtitle the company chose calls this a strategic pivot from IP to physical silicon. Our read is that the word pivot is doing an enormous amount of work on that line. A business that used to collect a fee and go home now owns lead times, inventory, and yields. That changes what you are actually buying when you buy this stock, so stay with me. Before the numbers, let me make sure you know how this company has always made its money. The company describes two streams in the traditional model, and they behave nothing alike. The first is the license, the entry fee, an upfront cost to access the design blueprints. The company notes it is lumpy, negotiated, and subject to timing volatility, which is a polite way of saying it jumps around. The second is the royalty, the toll, a fee collected on every single chip sold. The company calls that highly visible, compounding, recurring revenue. And I'd agree that's the crown jewel of this business. Now here's the change stated right on this page. For the first time, ARM is bypassing the toll booth to manufacture and sell physical chips. The landlord who collected rent for 30 years just opened his own shop in the building. Our take is that this is not a product launch, it is a business model change. Almost everything confusing about this quarter comes from those two models running side by side. Now the scorecard, and the company puts two beautiful numbers up first. Operating margin of 41% and free cash flow of $665 million. Do the math yourself. That is a software-like profile sitting inside a semiconductor company. But the company is also honest about what sits underneath the licensing line. Total license revenue was $574 million, and of that $193 million came directly from agreements with parent company SoftBank. That's 33% of licensing, disclosed by the company itself as a related party caveat. To be fair, the bulls have a real point here, and I want to give it to them properly. SoftBank is a genuine customer with genuine chip programs, and those agreements are real work with real deliverables. Still, our take is that a third of your licensing coming from your controlling shareholder deserves a discount in your model. I'm maybe 70% on this strip it out, and underlying licensing growth looks good rather than spectacular. Keep that $93 million in your pocket because it comes back later. Here's the data, and honestly it's the strongest page in the whole deck. The company shows NVIDIA, Google, AWS, Microsoft, and Qualcomm all orbiting one block. Every one of them is at war with the others in the AI race, and every one of them, according to the company, uses ARM architecture as their foundational bedrock. The company reports that drove a 100% plus year-over-year surge in data center royalties. Doubled. Yeah, in a single year. Think about it, when the combatants are all fighting, who reliably gets paid? The one selling the ground they're standing on. Our read is that this is the cleanest structural argument for owning this name, full stop. It does not require you to guess which hyperscaler wins the AI build-out. It only requires the build-out to keep happening, and is that slowing down? I don't see it yet. This page is one chart, and it deserves a lot more than one sentence. The company states that the first 1 billion Neoverse cores took 6 years to ship. The next 500 million took 9 months. 6 years, then 9 months. Let that sit for a second. The company says the slope has fundamentally changed, and a structurally steeper adoption curve means compounding, volume-based royalties for years to come. Here's why that matters more than any headline growth rate. Royalties are a per-unit toll, so cumulative cores are the installed base that keeps paying you. A steeper curve doesn't just lift this year, it raises the floor under every year after it. Now the honest caveat, and this one is ours, not the company's. Curves like this get pulled forward by a capex boom, and capex booms breathe in and out. Our take is that the direction is real, while the exact angle of that slope is something we'd hold loosely. Mobile is where this story gets genuinely interesting and a little uncomfortable. The company reports the terminal market is down double digits because of memory cost inflation, fewer phones getting built. That's the left side of the scale, and it's heavy. But the company also reports ARM's mobile royalties are still growing double digits. How do you earn more while your customers ship less? The company points at ARM v9 and CSSC migrating customers to newer architectures carries higher baseline royalty rates. Same phone, more dollars to ARM. That is pricing power, plain and simple. The company calls it a powerful buffer against volume declines, and honestly, that's a fair description. Here's our worry though, and it's ours alone. A buffer is not a moat, it's a cushion. Migration to ARM v9 is a one-time step up per customer, and eventually everyone has migrated. Then unit volumes start mattering again, and we suspect that day arrives sooner than this page implies. Now we get to the thing everybody actually wants to talk about. The company states the AGI CPU launched in March 2024, a massive 128-core design aimed at proxy AI workloads. On demand, the company says immediate demand exceeds $2 billion with a top-tier client list including OpenAI, Meta, and Oracle. Read that list again, because those are not experimental design wins. Those are the biggest compute buyers on the planet raising their hands. And then the company says something you almost never hear a management team admit out loud. For the first time in company history, the growth constraint is not customer adoption, it is physical manufacturing. I'm telling you, that one sentence is the entire quarter compressed into a line. For 20 years, the question for a chip IP company was, will anyone adopt this? Now the question is, can you actually build it? Completely different problem, completely different skill set. Our take is that demand this validated is a wonderful problem to have, right up until it isn't. So why is supply stuck? The company lays out every layer, and none of them are easy fixes. TSC wafer capacity, advanced substrates, high bandwidth memory, and testing equipment, all flagged as tight. The CEO confirms systemic tightness across every single layer, according to this page. And here's the line that should stop you cold. Even peers within house foundries cannot secure adequate supply. If owning your own fab doesn't save you, then money alone doesn't save you either. The company states meaningful expansion is delayed until calendar year 2028. That is not next quarter, that is not even next year. So do the math against the previous page. Over 2 billion in demand, 1 billion in supply. Roughly half of that order book simply cannot be filled, and the company is telling you that openly. To be fair, being supply constrained is very much the good version of this problem. But our red is blunt. Revenue you cannot ship is not revenue. It's a press release. Here's the page I'd print out and tape to the wall before you touch this stock. The company puts old ARM and new ARM side by side, and the contrast is brutal. Old ARM sold blueprints and rules, with gross margin near 100%. New ARM sells finished AGI chips, and the company guides first-generation gross margin at high 30s to low 40s%, from near 100 down to around 40. That is not a dip, that's a different company. The company adds it will take years to reach a 50% margin by bringing ASIC work in-house. And once silicon hits 10% of total revenue, the company says the margin profile of the entire company will permanently shift. Permanently. That's their word, not ours. Now the bulls would push back here, and they'd be right too. $1 or 40% margin revenue can still be worth far more than a toll you never get to collect. Our take is that the multiple you pay for near 100% margins is not the multiple you pay for 40%, so some repricing is coming. Now the number that got the market's attention, and it's the one to sit with. The company originally expected full-year royalty growth of around 20%. It has now proactively revised that down to high teens, with specific Q2 guidance of 13%. 20 to high teens to 13. Watch that stair-step down. The company names the catalyst directly deterioration in mobile from bill of materials cost inflation. That inflation has aggressively infected the mid to high-end smartphone tiers, dragging down automated royalty revenue per the company. Let me Steelman management here, because I think they've earned it. They cut this guidance before they were forced to, and they named the reason without hiding behind vague macro language. That's the behavior of a team that plans to be believed later, and I respect it. Our read, though, is that the engine of this business just downshifted while everyone was staring at the new toy. Truthfully, I can't tell yet whether 13% is the floor or just a waypoint, and we'll know next quarter. This page is really about the quality of a dollar, and not every dollar is equal. The company describes royalties as the engine, an automated compounding fee on every chip shipped, highly visible and stable. Licensing, by contrast, the company calls lumpy, negotiated, and volatile. It's the plug rather than the engine. And this quarter licensing revenue surged 30%, which the company notes mathematically offsets the royalty dip. Mathematically offset, those two words are the tell. The top line looks fine, but the mix sitting underneath it got worse. Now the company hands you the tool to check its own work, and I genuinely appreciate that. Annualized contract value is up 13%, which the company calls the single most important metric on this page. It tells you whether licensing growth is structural or just one big deal landing in a convenient quarter. Our take is that 13% ACV against 30% licensing revenue growth means part of this quarter's plug is timing. Track ACV every single quarter, and you will never be fooled by a lumpy licensing print again. Here's a small page that says something big about management's character. The company's official addressable market estimate, dated March, is $100 billion plus. The market's new whisper number, shown right on this page, is $220 billion. More than double, and ARM management strategically refuses to publicly update its own model. Think about how rare that behavior is in this particular market. Peers are touting inflated AI forecasts, and this company is sitting on its hands. The page calls Restraint in an exuberant market a calculated signal, and we agree with that framing. A team that won't chase the whisper number is usually a team that intends to hit the number it gave you. I'll own a mistake here. I've been burned before by management teams that raised their TAM every quarter and delivered none of it. That said, the bears would say restraint can also mean they lack the visibility to raise it. Our read leans toward discipline, maybe 65%, but we're not calling it proof of anything. Two threats on this page, and the company treats them very differently. First, open source AI models rated neutral to net positive. The reasoning shown is that all models require CPUs, and highly efficient smaller models pushed to the edge directly benefit ARM's mobile dominance. That one I buy. More inference happening at the edge means more ARM cores doing the work. Second, custom accelerators, and here the threat level is listed as unknown. The page states coexistence is proven today, but the long-term threat of marginalization by hyperscaler accelerators was left explicitly unanswered by management. Explicitly unanswered. Not deflected, not spun, unanswered. Pay attention here because that is the honest risk in this entire story. Every hyperscaler on that earlier royalty page is also building its own silicon. Today they build it around ARM, and our take is they will for years because the software ecosystem is enormous. But if that ever changes, it changes everything, and management did not tell you it won't. This page does the work most decks never do. It translates management's own highlights. Management highlighted that ARM server spend has surpassed x86. The translation given here is that the IDC data measures accelerated server platforms, not the entire traditional server CPU market. True, and considerably narrower than the headline makes it sound. Management highlighted that overall revenue won't decelerate. The translation that relies heavily on volatile licensing revenue and roughly $200 million of run rate SoftBank related party transactions. There's our number from earlier coming back exactly as promised. Management highlighted that AGI CPU margins remain unchanged today. The translation suit true for the immediate timeline, but physical chips inherently drag down blended margins, and the impact hits in fiscal 2028. Notice the pattern across all three rows. Nothing here is false, and everything here is incomplete. Our take is that this is what a good management team sounds like when the honest answer simply isn't ready yet. Want to know what the professionals on the call actually cared about? The page says one topic came up 6 times during Q&A: AGI CPU supply and margins. 6 times. Analysts don't repeat a question because they forgot they asked it. They repeat it because they didn't get an answer. On the present, the page describes management as extremely candid, openly acknowledging systemic bottlenecks. On the future, it describes strategic deflection with definitive revenue and margin roadmap updates explicitly pushed to the Q3 call. Candid about today, quiet about tomorrow. That is a deliberate choice. To be fair, guiding a brand new hardware business you cannot yet supply would be reckless. If they had handed us a confident fiscal 2028 margin number today, I'd trust them less, not more. But our read is plain. The market is being asked to underwrite this pivot on faith for one more quarter. That is the setup heading into Q3, and it's exactly why Q3 matters so much. Here's the whole thesis in a single image. I think this page nails it. The toll booth model captures a fixed percentage, which the page says leaves the excess profits of the AI boom to the manufacturers. That's the ceiling. ARM gets a slice no matter how enormous the pie gets. So, For this page, ARM is deliberately trading its flawless near 100% margin percentage to capture the full absolute sticker price of physical silicon. Deliberately. That word matters because this isn't drift, it's a decision. Picture a landlord who's collected 3% of every shop's sales for 20 years. He watches those shops get rich, and one day he opens his own store on the ground floor. His margins get worse. His dollars can get much bigger. Our take is that the strategy is correct, and the transition is where investors get hurt. During the crossover, you pay for the old margins and you receive the new ones. That gap is the real risk, and it lands squarely in fiscal 2028. The company closes with 8 things to monitor, grouped into 3 buckets, and this is your homework. Validating the pivot, the Q3 earnings call with its crucial roadmap update, year-end delivery of the AGI CPU, and the fiscal 2028 breakout when silicon hits 10% of revenue. Health of the old engine, royalty growth holding the high teens line, the ACV trend maintaining structural strength, and the SoftBank related party dependency run rate. Long-term trajectory, the Neoverse shipment volume slope, and supply chain capacity loosening before calendar year 2028. Notice that half of this list is about whether the old business holds up while the new one gets built. That is exactly the right way to watch it, and I'd rank the Q3 call first by a mile. Alright, last thing, radar always leaves you a light. I'm calling this one yellow. The business is flat out impressive. Data center royalties doubled, and the pivot into silicon is the right call. But the engine guidance just stepped down twice. The new product can only ship about half its demand, and the margin hit is real. Too many moving parts land in the same window for me to want it at this price. Here's what flips me to green: royalty growth holds high teens, ACV keeps climbing, and Q3 delivers an actual margin roadmap. If they clear those 3, I'll say plainly that I was too cautious, and I'm telling you that up front. Red comes only if royalties slip below the teens while supply stays locked into 2028. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar. Hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.